Welcome to Iron Financial. We're not here to follow the market, we're here to stress test it. Our mission is to help you forge a stronger, more resilient portfolio. How? By cutting through the hype, getting past the noise, and really examining the structural integrity of the assets you're considering. We put companies on the anvil, and we see if they can take the heat.
All right, let's get right to it. On the block today, we've got WeRide, ticker WRD. Now, these guys are a major global player in the autonomous driving space. In fact, they're the very first publicly traded robotaxi company to hit the market. And the reason we're talking about them today is because they just dropped their Q4 and full year 2025 earnings. And frankly, the numbers are making some serious waves. So we're going to break it all down piece by piece and see if this thing is really built to last.
And really, this is the entire story right here, isn't it? This is the central question every investor is asking. The top-line growth is absolutely explosive, hitting 123% year over year. I mean, you just don't see numbers like that every day. It absolutely screams ground floor opportunity, especially in an industry that some analysts are projecting could be worth well over $1 trillion by 2030. This could be the kind of foundational investment that defines a portfolio for a generation.
Or let's pump the brakes a little. It could be a very fancy high-tech furnace that's just been engineered to burn through investor cash at an incredible rate. Look, that kind of growth never, ever comes cheap. Hype builds really fast, but you know what? Foundations crack slow. Before we get excited about the shiny new skyscraper, we need to look at what's happening in the basement. We need to check the plumbing and see what's really holding this whole thing up.
Exactly right. And that's why we always come prepared with a blueprint. So here's how we're going to tackle this. First, we're going to look at what's driving this robotaxi gold rush, all those top-line numbers grabbing the headlines. Then, second, we'll unpack the revenue engine itself and see what's actually under the hood. Third, and this is your territory, we're going to examine the high cost of tomorrow. We're going to stress test that foundation. Fourth, we'll assess their financial armor, their so-called billion-dollar war chest. And finally, after all that, we'll deliver our final verdict. Let's get to work.
Okay, Section 1. Before we can even begin to talk about the costs, we have to understand what's driving all this excitement. We need to look at the core beams and columns that are supporting this growth. These are the numbers that have the bulls running wild, and we need to see if they're as strong as they look. So, let's start with the big one, the one everyone's talking about.
And here it is. This is the headline number, the main support beam holding up the entire bull case, 123%. That is the year-over-year revenue growth for the fourth quarter. You have to put that in perspective. In this market, any company that's even close to doubling its revenue is a massive standout. This isn't just a little bit of growth, this is a powerful statement. It signals incredible market traction and what appears to be massive pent-up demand. It tells you that their product is not only out there, but it's hitting the mark with customers. But honestly, that 123% doesn't even tell you the most important part of the story. You have to drill down. You have to ask, where is that growth coming from? And look at this. Product revenue, it's up a staggering 309%. Just let that sink in for a moment. To me, this is the most crucial number on the entire earnings report. This is what proves they aren't just a service company or some abstract software concept anymore. No, they are a manufacturer. They are selling hard assets. We're talking robotaxis, robobuses. They are moving metal, and they are moving it fast. This is the heavy lifting that builds a real, tangible business with a physical footprint.
And if we want to get even more specific, let's just isolate the core of their business, their bread and butter. Robotaxi revenue, their flagship offering, is up a very, very healthy 66.4%. This isn't some side project or a secondary revenue stream. This is the main event. This number right here provides the hard evidence, the proof, that their primary commercial offering isn't just being tested in a lab somewhere. It's being adopted, it's being monetized, and it's happening at a significant clip. You could say the core furnace is getting hotter and hotter.
So, okay, let's put it all together now. Just look at this table. It tells the whole story. In the fourth quarter of 2024, product revenue was just a rounding error, really, 51.7 million RMB. Fast forward just 1 year, it's exploded to 211.4 million. That is a monumental shift. They've transformed from a primarily service-based model to a product sales powerhouse in 12 months. And look at the full year numbers, they nearly doubled their total revenue. This is the very definition of hypergrowth. This is the structure going vertical at lightning speed.
Okay, I see it. The skyscraper is going up fast, no doubt about it. But my question is, what about the cost of all that steel and glass? What's the bill for this thing? Selling more hardware is great. It looks fantastic on a chart. But if you're losing money on every single unit you push out the door, then all you're really doing is accelerating your path to bankruptcy.
Growth is one thing. Profitable, sustainable growth is a completely different animal. So let's talk about the bill. Let's see the invoice for this skyscraper.
And that brings us perfectly to the next phase of our inspection. We're calling this the high cost of tomorrow. This is the part where we take out the hammer and we start tapping on that foundation to listen for any hollow sounds, any cracks. The revenue story, I'll admit, it's impressive. It's shiny, but it's only half the story. The other half, well, that's written in very bright red ink.
Now this slide, this right here puts the fundamental conflict into stark relief. You can't ignore this. On the left, you've got that beautiful, headline-grabbing 123% revenue growth. But on the right, you've got the price tag, a net loss of 556 million RMB. That's nearly 80 million US dollars in a single quarter. And for the full year, the net loss was 1.7 billion RMB, which is about $237 million. Let me put it another way. They're spending almost 3 RMB for every single RMB they bring in. This isn't just the cost of doing business. This is a massive, raging cash burn that raises very serious questions about the long-term sustainability of their entire model.
And here, for me, is the first major stress fracture. Their gross margin is shrinking. It's going in the wrong direction. Back in Q4 of 2024, for every dollar of revenue they generated, they kept 36.5 cents to cover their operating costs, R&D, and hopefully one day profit. Just 1 year later, that number has dropped to 28.5 cents. So think about that. While they are selling a lot more, they are becoming less profitable on each individual sale. Now, the company says this is due to a lower contribution from some higher margin R&D services, but I don't care what the reason is. It's a dangerous trend. As a business scales, you want to see those margins expand, not contract.
So where is all this money going? Well, a big chunk of it is right here. Look at the research and development budget. It jumped from 1.1 billion RMB in 2024 to 1.4 billion in 2025. This is the technological arms race of the 21st century, and it is incredibly, unbelievably expensive. You're not just competing with other startups, you're competing with the deepest pockets in the world. So the question for any investor has to be, can they keep this pace up? How long can they afford to burn through cash at this rate before the well finally runs dry?
But see, you're calling it burning cash. I see it as building a moat. You have to understand, in this industry, the company with the best technology, the safest platform, wins. Everything else is secondary. That 1.4 billion RMB isn't an expense in the traditional sense. It's a strategic investment in a future-proof platform. You simply cannot build a global leader on a shoestring budget. This is the necessary cost of forging a truly dominant market position.
Which brings us to the perfect counter-argument, the cash burn. It looks scary when you look at it in a vacuum, but you can't do that. You have to look at it in the context of the balance sheet. So let's shift gears and assess the company's financial armor. A company's ability to withstand pressure, to survive the lean times, comes directly from its core financial strength. And this number right here is the ultimate defense. This is their fortress. As of the end of 2025, WeRide is sitting on 1 billion, that's billion with a B, US dollars in cash, cash equivalents, and other liquid assets. So this isn't some startup that's running on fumes hoping for another funding round. This is a financial fortress. That billion-dollar war chest gives them the power to fund their R&D, to absorb the losses we've been talking about, and to execute their very aggressive growth strategy without having to run back to the market for more cash every few months. In short, it buys them time and flexibility. And for a growth company, those are the two most valuable assets you can possibly have. Now, let's get a little more technical and actually look at the financial architecture here. This data from Guru Focus, it tells a really powerful story. Their current ratio is 8.39. That means they have over $8 of current assets to cover every $1 of current liabilities. That is exceptionally strong liquidity. Now look at the debt-to-equity ratio, 0.05. That is practically zero. This company is not burdened by debt at all. And finally, the Altman Z-score, which is a common predictor of bankruptcy risk, it's at 11.83. For context, anything over 3 is considered safe. This score indicates incredibly strong financial health. So the concerns about financial risk, they're valid in theory, but when you look at the actual data, the structure here is remarkably sound. And here, this is the crucial point, and it comes straight from the CFO, Jennifer Li. Yes, they are spending heavily, we've established that. But, and this is a big but,
They are also getting more efficient. The operating loss actually narrowed by 15.5% for the full year. So this isn't a fire that's raging out of control. It's a controlled burn. They are managing to scale up their operations while simultaneously tightening their belts and finding new efficiencies. To me, that is the hallmark of a well-managed growth company. It shows discipline, and more importantly, it points toward an eventual credible path to profitability.
Okay, so we've examined the structural beams of revenue, and we've taken the hammer to the foundation to test for costs. Now it's time to bring it all together and deliver the final verdict.
That's right. Is this a genuine opportunity that's being forged in the fires of innovation, or is it a carefully constructed financial trap that's just waiting to spring on unsuspecting investors? Let's lay out both cases, side by side.
All right, the bull case. It's built on a very powerful structure. First, you have that explosive triple-digit revenue growth. You just can't argue with that kind of momentum. Second, you have a first-mover advantage in what appears to be a dominant position in a market that's projected to be worth $1.5 trillion. Third, you have an ironclad balance sheet, $1 billion in cash and almost no debt. That's your safety net. Fourth, they're expanding rapidly across 12 countries using a very smart asset-light model. And finally, and this is crucial, while they are still losing money, those losses are shrinking year over year. This is the blueprint for what could become a future titan of industry.
But the bear case points to some very serious cracks in that exact same structure. First, the net loss is simply staggering. We're talking nearly $250 million in 2025 alone. Second, that declining Q4 gross margin is a major red flag for me. You simply cannot scale your way out of bad unit economics. It doesn't work. Third, the R&D cash burn is accelerating, it's not slowing down. Fourth, the stock itself is wildly volatile, with a volatility measure of over 92%. This is not for the faint of heart. And finally, we haven't even really touched on the immense competition from some of the biggest, richest tech companies in the world, or the absolute maze of regulatory hurdles they have to navigate in every single new market they enter.
But the CEO's vision addresses that risk directly. Tony Han says they're building a leading global platform. And those key words, global platform, are everything. See, they're not just trying to sell cars. They're trying to build the underlying operating system for the future of mobility. The fact that they already have a presence in 12 countries proves that this isn't just a regional play. This is a global land grab, and right now they're planting their flags faster than anyone else. That ambition, that vision, is what underpins the entire bull thesis.
And a huge piece of that global strategy is their asset-light model. This is key. They aren't trying to own and maintain tens of thousands of vehicles themselves, which would be incredibly capital-intensive. Instead, they partner with local fleet operators and leasing firms. This is a brilliant capital-efficient way to scale. It lets them enter new markets much faster and with a lot less upfront investment. It's a modern, smart approach to building a global transportation network.
I'd call it a risk transfer model, not an asset-light model. It sounds smart on paper, but what it really does is outsource risk and create a web of dependencies. Does it truly insulate them? What happens when a partner in another country cuts corners on safety to save a buck? Suddenly, that's a WeRide headline to deal with, not the partners. What happens in 5 years when a major leasing contract is up for renewal and their partner suddenly has all the negotiation leverage because they own all the cars? It's faster, I'll give you that, but it may not be as durable in the long run. It just adds another layer of complexity and potential failure points to a business that's already incredibly complex.
And that really brings us right to the final question, the one you, the investor, have to answer. WeRide is building a skyscraper. The ambition is undeniable, the growth is astronomical, and that cash position provides a deep, solid footing. From my perspective, the narrowing losses and the clear operational efficiencies show that they're building with skill, not just with speed. They're managing the project well, but every skyscraper has to face storms, and those declining margins are a real concern. That cash burn is a hurricane-force wind that is constantly blowing against the structure. So the question you have to answer is this. Is the foundation they've laid, that $1 billion in cash and that low debt, is it strong enough to support the immense weight of their global ambitions and withstand the inevitable storms of competition and regulation that are surely coming? This is either a brilliant work in progress on its way to becoming an iconic landmark, or it's a fundamentally flawed design that's destined to fail. The market will be the final inspector. Here at Iron Financial, our job is just to show you the blueprint. The decision to invest, well, that's yours to forge.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.